Okay, I will explain about bookkeeping. Bookkeeping. The main aim of every business is to earn profit. Profit is nothing but the excess of income over expenditure. So, to calculate profit, the businessman must record the incomes and expenditure related to his business. This recording of business transaction is called bookkeeping. Thus, bookkeeping means recording, classifying, and summarizing business transaction systematically so that the businessman may be able to know his profit or loss during a specific period. Bookkeeping. It is the recording on a day-to-day basis of the financial transaction and information pertaining to a business. It is concerned with ensuring that record of these individual financial transactions are accurate, up-to-date, and comprehensive. Bookkeeping provides the information from which accounts are prepared but is a distinct process, preliminary to accounting. Each transaction, whether it is a question of purchase or sale, or change of loans, has to be recorded in the books. Bookkeeping includes: first, billing for goods sold or service provided to client, recording receipt from customer, verifying and recording invoice from supplier, paying suppliers, processing employee pay and the related governmental report, monitoring individual account receivable, recording depreciation and other adjusting entries, and the last, providing financial report. Why bookkeeping? First, to keep receipt or other acceptable record of every payment to and every expenditure from our business. Second, to summarize our income and expenditure record on some periodic basis, generally daily, weekly, or monthly. And the last, to use our summaries to keep financial report that will use specific information about our business, such as how much monthly profit you are making or how much your business is worth at specific point in time. Next, will present by Fakran Tanika.
Record keeping. The first one is the definition of record keeping. Record keeping is part of bookkeeping in accounting. Recording is the process of getting data on gross income or revenue and/or gross stage as the basis for determining the amount of tax due, the stage that is not a tax item, and/or is a subject to final tax. There are two kinds of person that have a record keeping obligation. The first one is individual taxpayer who carry out business activities or independent work whose gross circulation in 1 year is less than 4,800,000,000 rupiah, can calculate net income using the net income calculation norm, provided that they notify the Director General of Tax within the first 3 months of the tax year concerned. The second one is individual taxpayer who do not carry out business activities or independent work. Record keeping requirement. There are 3 requirements for record keeping. The first one, the record must reflect gross revenue or circulation and or total gross income received or earned, income that is not a tax object, and or income whose tax imposition is final. The second one is for taxpayers who have more than one type of business and or place of business. The record must clearly describe each type of business and or place of business concern. The last one, apart from the obligation to keep record, individual taxpayer must keep records of their asset and liability. The purpose of record keeping. Record keeping has the same purpose with the bookkeeping. The first one, explicitly linked, calculation of taxable income, PPN and PPNBM calculation. Books, notes, or document storage place. Books, records, and documents that form the basis of bookkeeping or other records and documents including the result of data processing from bookkeeping, managed electronically or by an online program, must be kept for 10 years in Indonesia. namely at the place of activity or place of residence, individual tax, or at the domicile of the corporate taxpayer. The difference between bookkeeping and record keeping. In bookkeeping, those who are obligated to keep books of account are corporate taxpayer and personal taxpayer who carry out business activities in or independent work. Meanwhile, record keeping, those who are obligated to keep record are individual taxpayer who carry out business activity or independent work with a gross turnover in 1 year of less than 4.8 billion rupiah and individual taxpayer who do not carry out business activity or independent employee. In bookkeeping, at least consists of record regarding asset, liability, capital, income, and expense, as well as sales and purchases, so the amount of tax payable can be calculated. In recording, consists of data that is regularly collected regarding the gross revenue and or gross income as a basis for calculating the amount of tax owed. This includes income that is not subject to tax and or which is subject to final tax.
My name is Farhul Ramanzata and I will continue the presentation. Excluded from bookkeeping obligation. Who is excluded from bookkeeping obligations? In principle, individual taxpayer who carry out business activities or free employment and corporate taxpayer in Indonesia are required bookkeeping. This bookkeeping obligation is regulated in Article 28, Paragraph 1 of the Undang-Undang KUP. However, accordance with Article 28, Paragraph 2 of the Undang-Undang KUP, the obligation of bookkeeping is excluded for individual taxpayer who carry out business activities or independent work, which in accordance with the provision of the tax law are allowed to calculate net income using the net income calculation norm or NPPN. It means individual taxpayer who run a business or do independent work with a gross amount of less than 4.8 billion rupiah in a year are excluded from bookkeeping obligation. As a substitute, taxpayer who fall under this criteria are still required to keep records. This registration obligation also applies to taxpayers who do not carry out business activities or independent work.
Okay, I will continue to explain about methods of bookkeeping and recording. Methods of bookkeeping. The first one is single entry bookkeeping. Single entry bookkeeping is a straightforward method where one entry is made for each transaction in your books. These transactions are usually maintained in a cash book to track incoming revenue and outgoing expense. The second is double entry bookkeeping. Double entry bookkeeping is more robust. It follows the principle that every transaction affects at least two accounts, and they are recorded as debit and credit. In double entry system, the total credit must always equal to total debit. Third is cash based and accrual based. In cash method, you recognize revenue when you receive cash into your business. Expense are recognized when they are paid for. In other words, anytime cash enter or exit your account, they are recognized in the book. This means that purchase or sale made on credit will not go into your books until the cash exchange. In accrual method, revenue is recognized when it is earned. Similarly, expenses are recorded when they are incurred, usually along with corresponding revenue. The actual cash does not have to enter or exit for the transaction to be recorded. You can mark your sale and purchase made on credit right away. And I will explain how to record entries in bookkeeping. The first one, you can use cash register. A cash register is an electronic machine that is used to calculate and register transactions. Usually, cash registers are used to record cash flow in store. The second is the journal. The journal is called the book of original entry. It's the place where a business chronologically records its transaction for the first time. A journal can be either physical or digital. The third is the ledger. A ledger is a book or a compilation of accounts. It is also called the book of second entry. After you enter transaction in a journal, They are classified into separate accounts and then transferred into the ledger. These records are transcribed by accounts in the order like asset, liability, equity, income, and expense. The fourth is trial balance. The trial balance is produced from the compiled and summarized ledger entries. The trial balance is like a test to see if your books are balanced. It lists the account exactly in the following order, like asset, liability, equity, income, and expense with the ending account balance. Fifth is financial statement. The next and probably the most important step in bookkeeping is to generate financial statement. These statements are prepared by consolidating information from the entry you have recorded on day-to-day basis. They provide insight into your company performance over time, revealing the areas you need to improve on. The sixth, the cash inflow statement. The cash flow statement is exactly what its name suggested. It is a financial report that tracks incoming and outgoing cash in your business. It allows you, an investor, to understand how well your company handles debt and expense. The seventh is the balance sheet. The balance sheet report is a business asset, liabilities, and shareholder equity at a given point in time. In simple words, it tells you what your business owes and the amount invested by shareholders. The eighth, the income statement. The income statement, also called the profit and loss statement, focus on revenue gain and expense incurred by a business over time. And the last one is bank reconciliation. Bank reconciliation is the process of finding congruence between the transaction in your bank account and the transaction in your bookkeeping record. I think that's all that I can explain to you. Assalamualaikum warahmatullahi wabarakatuh.